If you were to overlay a chart of gold prices with the dates of America's major financial crises over the past 50 years, you would see something remarkable. Gold doesn't spike when the crisis hits. It rises beforehand months, sometimes years in advance. The pattern repeats with unsettling consistency. In 2006 and 2007, while the housing market soared and banks reported record profits, gold was climbing steadily. By the time Lehman Brothers collapsed in September 2008, gold had already doubled from its low. It wasn't reacting to the crisis. It was a warning of it. The same thing happened before the inflation crisis of the 1970s. The same thing happened before the dot-com collapse. And right now, gold is doing it again. It has risen over 80% since 2019, breaking through all-time highs even as the stock market climbs and the economy, by most official measures, appears strong. So the question we need to ask is simple and urgent. What is gold telling us right now? This documentary won't predict the future or tell you what to do with your money. What it will do is examine the historical record clearly, factually, and without exaggeration, because gold has a track record, and that track record suggests we should be paying attention. To understand what gold is saying, we need to understand what gold actually measures. Gold is not just a commodity. It is a measurement, a gauge of confidence in the financial system itself. When confidence in currency, government stability, and the broader economy is high, gold tends to fall or remain flat. People don't need insurance when they believe the system is sound. But when that confidence begins to erode, even quietly, even before most people notice, gold starts to rise. This movement happens long before any visible crisis. Gold doesn't wait for the headlines or the market crashes. It moves on the fear of what's coming, not on the reality of what's already happened. This is what makes gold different from almost every other asset. Stocks react to earnings reports, bonds react to interest rate changes. Gold reacts to something deeper and harder to quantify: the collective loss of faith in the stability of money itself. Gold has played this role for centuries. It has been crisis insurance for empires, kingdoms, and modern economies alike. When the Spanish Empire collapsed under debt in the 1600s, those who held gold survived. When currencies failed during the wars of the 20th century, gold retained value while paper money became worthless. The reason is structural. Gold cannot be printed by a central bank. It cannot be devalued by government decree. It cannot be defaulted on or inflated away. It simply exists, finite and unchanging, which makes it the natural refuge when trust in everything else begins to crack. The historical data supports this pattern with uncomfortable consistency. In the 2 to 3 years leading up to major U.S. financial crises, gold has risen an average of 50 to 200%. Not after the crisis becomes obvious to everyone, but before a while, economists are still optimistic, while markets are still climbing. While the system still appears stable on the surface, gold moves early because the institutions that buy it in large quantities, central banks, sovereign wealth funds, large financial players, see the stress building before it becomes public knowledge. Their quiet accumulation drives the price higher, and that rising price becomes the signal. This is why gold is often called a fear gauge. It measures something intangible but real: the confidence that the people who manage the largest pools of money in the world have in the current system. When that confidence is strong, they don't need gold. When it weakens, they buy. And when they buy in large enough quantities over a sustained period, the price tells a story. The question then is not whether gold can predict a crisis with precision. It cannot tell you the exact month or the specific trigger. What it can tell you is that the conditions for a crisis are building, that the people with the most information and the most to lose are quietly preparing for something to go wrong. Let's look at the first time modern America learned this lesson. In August 1971, President Richard Nixon made a decision that would fundamentally alter the global financial system. He ended the gold standard, severing the last link between the US dollar and physical gold. For the first time in history, the world's reserve currency was backed by nothing tangible on the promise of the government that issued it. The dollar became fiat currency, valuable because the government said it was, not because it could be exchanged for anything real. At the time, gold was fixed at $35 per ounce, a price that had been locked in place by government decree. But once that link was broken, the price was free to move, and it did. Between 1971 and 1974, gold climbed steadily, reaching $120 per ounce. Most Americans didn't understand why. The economy still appeared stable. There were no visible signs of crisis. Yet gold kept rising, as if measuring something the public couldn't yet see. From 1975 through 1979, the climb accelerated. Gold passed $200, then $300, then $500. Still, mainstream economists dismissed it as speculation or irrationality. The official narrative remained optimistic, but gold was telling a different story. Then the crisis arrived. In 1979 and 1980, the United States experienced stagflation, a toxic combination of high inflation, stagnant growth, and rising unemployment. Gas lines stretched for blocks as energy prices spiked. Interest rates soared into the double digits. The purchasing power of the dollar collapsed. By 1980, inflation had reached 14%, and the economy was in chaos. Gold peaked at $850 per ounce. In January 1980, that represented a 2,300% increase from its starting point in 1970. Those who had bought gold in the early 1970s, when the system still seemed sound, had protected themselves. Those who waited until the crisis became obvious had already missed most of the move. The key observation is this: gold didn't react to the inflation crisis of 1979 and 1980. It warned of it years in advance. What gold had been measuring all along was the loss of confidence in the dollar. Once it was no longer anchored to anything real, 20 years later, gold would send another warning. This time, no one was listening. By 1999, gold had fallen to $290 per ounce, 20-year low. The internet boom was in full swing. Technology stocks were doubling and tripling in value. The economy appeared unstoppable. Gold, by contrast, seemed like a relic who needed insurance when the future looked so bright. Then, in 2001 and 2002, gold began to climb. It passed $300, then $350, then $400. The movement was quiet at first, easy to miss amid the noise of the collapsing dot-com bubble. Between March 2000 and October 2002, the stock market lost nearly half its value as the speculative frenzy in technology companies evaporated. Trillions of dollars in wealth vanished. Most investors fled to bonds or cash, trying to salvage what they could. But those who had moved into gold before the crash who had noticed the reversal in 1999 and early 2000 found themselves protected. Gold had bottomed and turned upward months before the bubble burst, as if sensing the instability before it became visible. But the real warning was still ahead. From 2002 through 2007, gold rose steadily and relentlessly. $400 became $500, then $600, then $700. By this time, the U.S. housing market was booming. Home prices were climbing at double-digit rates year after year. Subprime mortgages were being packaged into complex financial instruments and sold around the world. Banks reported record profits. The media celebrated the strength of the economy. The Federal Reserve and Treasury Department assured the public that the financial system was sound and well-regulated. Gold kept climbing, $800, $900, $1,000. By 2008, it had more than doubled from where it had been just 3 years earlier. Yet the mainstream narrative remained unchanged. Housing prices would keep rising. The financial engineering was safe. Everything was under control. Then, in September 2008, Lehman Brothers collapsed. The fourth largest investment bank in the United States filed for bankruptcy, and the entire global financial system froze. Credit markets seized. Banks stopped lending to each other. The stock market plummeted. Within weeks, the government was forced to intervene with trillion-dollar bailouts to prevent a complete meltdown. Gold had been warning of it for 6 years, not reacting to it warning of it. By the time the crisis peaked in 2011, gold had reached $1,900 per ounce, a 550% gain from its 2001 low. What it had been measuring all along was unsustainable debt, overvalued assets, and systemic fragility. The pattern held. Gold did not spike when the crisis hit. It rose beforehand, driven by the quiet accumulation of institutions that could see the stress building. Investors who had moved even 10 to 20% of their portfolios into gold by 2005 or 2006 found themselves insulated from the worst of the collapse. Those who waited until 2008 had already missed the warning. the pattern had repeated twice in 30 years. But there's a third signal happening right now. In 2018, gold was trading between $1,200 and $1,300 per ounce. The price had been relatively stable for several years, moving sideways without any clear direction. Then, in 2019, it began to climb. $1,400, $1,500. The movement was steady and deliberate, the kind of rise that suggests accumulation by large institutions rather than speculation by retail traders. In 2020, the COVID pandemic hit, and the government response was unprecedented in scale. Trillions of dollars in stimulus flooded the economy. Interest rates were cut to zero. The money supply expanded at a rate not seen since the aftermath of World War II. Gold surged in response, climbing past $1,700, then $1,800, then breaking through $2,000 per ounce for the first time in history. From 2021 through 2023, gold consolidated around $1,800 to $2,000. It didn't collapse back to previous levels. It held its ground, fluctuating within a range but refusing to give up the gains. Then, in 2024, it broke out again. $2,400, $2,500, $2,600, and beyond. As of now, gold has risen more than 80% since 2019, and the climb shows no signs of stopping. What makes this different and unsettling is that gold is rising despite an official narrative of economic strength. The stock market is at all-time highs, unemployment is low, GDP is growing, yet gold is behaving as if a crisis is imminent. This is not the behavior of an asset reacting to visible problems. This is the behavior of an asset measuring invisible stress. The pattern is strikingly similar to the period between 2005 and 2007, when gold climbed steadily while the housing market boomed and the financial system appeared sound. Back then, most people ignored the signal because they couldn't see the problem. The same dynamic is playing out now. So what is gold measuring today? The most obvious answer is debt. The U.S. national debt now exceeds $36 trillion. Interest payments consume over $1 trillion per year. Gold appears to be pricing in the consequences of that imbalance long before they become visible. Gold may also be measuring persistent inflation. Despite aggressive interest rate hikes, inflation has proven difficult to contain. Additionally, in 2023, several regional banks failed in rapid succession, exposing vulnerabilities in the banking system. And perhaps most significantly, central banks around the world, particularly China and Russia, have been buying gold at record levels, signaling a loss of confidence in the dollar-based system. Gold's current behavior mirrors the pre-crisis patterns of the 1970s and 2000s. So if gold is warning us, what exactly is it warning us about? Historical analysis reveals that gold rises before three specific conditions emerge in the financial system. These conditions have repeated across different decades, different crises, and different economic environments. Understanding them clarifies what gold is actually measuring when it climbs over a sustained period. The first is currency devaluation. In the 1970s, gold surged as the dollar lost purchasing power following the end of the gold standard. In the 2000s, gold rose as the dollar weakened under the weight of mounting debt and persistent deficits. Today, gold's climb suggests growing concerns about the dollar's long-term stability. When a currency is being debased, whether through direct inflation, excessive money printing, or loss of global confidence, gold rises to reflect the diminishing value of that currency in real terms. The second condition is a systemic debt crisis. In the 2000s, gold began its climb years before the housing debt bubble became visible to the public. It measured the unsustainability of mortgage debt long before defaults and foreclosures made headlines. Today, government debt stands at levels that are unprecedented in peacetime. Gold rises when the ratio between debt and the ability to repay that debt becomes unstable. It doesn't wait for the default or the crisis it prices in the mathematical reality that the debt cannot be serviced indefinitely under current conditions. The third condition is a loss of confidence in the financial system itself. Before every major crisis, institutional investors begin shifting assets into gold. This is not driven by retail speculators or individual savers. It is driven by central banks, sovereign wealth funds, and large financial institutions and entities with access to information and analysis that the general public does not see. Their quiet accumulation reveals concerns that are not yet visible in stock prices, bond yields, or official economic data. The key insight is that gold does not predict timing. It predicts direction. A crisis might be 6 months away or 3 years away. Gold cannot tell you which. But when gold enters a sustained uptrend over multiple years, something historically breaks. The pattern does not fail, it simply unfolds on its own timeline. It's important to clarify what gold does not predict. It does not predict stock market crashes. Stocks and gold can both rise simultaneously. It does not predict immediate catastrophe or specific trigger events. What it does predict is loss of purchasing power, financial system stress, and the eventual need for crisis insurance. Brief rallies in gold can be noise, but sustained multi-year trends, like the one we are currently experiencing, have never occurred without eventually being validated by some form of financial disruption. The current gold trend has been in place for over 5 years, with consistent higher highs and institutional accumulation at record levels. Gold is not fortune-telling, it's not mystical, and it doesn't see the future. What it does is measure confidence in real time. When major institutions, central banks, sovereign wealth funds, pension funds lose confidence in the stability of the financial system, they buy gold. Their collective action creates the price signal. The rising price is simply the visible result of invisible concern. The historical accuracy of this signal is what makes it worth examining seriously. In the 1970s, gold warned of an inflation crisis, and that crisis arrived. In the 2000s, gold warned of a financial system collapse, and that collapse arrived. The current warning is still unfolding. The outcome is unknown, but the pattern is consistent. There are 3 possible interpretations of the signal gold is sending right now. The first is that gold is correct again. The United States faces significant financial stress in the years ahead, whether through unsustainable debt, renewed inflation, or a loss of confidence in the currency. The crisis materializes in some form, and those who heeded the warning early are protected, while others are not. The second interpretation is that gold is early but not wrong. The crisis is real, but it has been delayed by policy intervention or structural factors that temporarily mask the underlying problems. This was the case between 2005 and 2008, when gold climbed 4 years before the housing collapse became undeniable. The warning signal remains valid even if the timeline stretches longer than expected. The third interpretation is that this time is different. Structural changes in the global economy, advances in monetary policy, or unprecedented coordination among central banks have made the old patterns obsolete. Gold's warning is a false alarm, and the crisis it suggests will never arrive. The key observation is that option 3 has never been correct in modern history. Every time gold has given a sustained multi-year warning, a crisis has followed. The timeline has varied. The specific mechanism has varied, but the pattern has held without exception. Believing that this time will be different requires believing that something fundamental has changed in the way debt, currency, and confidence interact. And there is little evidence to support that belief. What we know for certain is this: gold is behaving exactly as it did in previous pre-crisis periods. Major institutions are accumulating it at record levels. The historical pattern suggests financial stress lies ahead. What we don't know is when that stress will become visible to the broader public. What form the crisis will take, or whether policy interventions can prevent it or merely delay it. Gold's current price at all-time highs and rising suggests that institutions are pricing in significant future uncertainty. They may not know the exact trigger, but they are preparing for instability. The signal is flashing. Whether it's right, again, remains to be seen. But history says we should be listening. The pattern is clear. 3 times in the past 50 years, gold has warned of crisis before it arrived. In the 1970s, it predicted the inflation and dollar collapse that followed the end of the gold standard. It was correct. In the 2000s, it predicted financial system stress years before Lehman Brothers fell and the global economy froze. It was correct. Today, gold is sending the same type of signal: a sustained multi-year rally accompanied by record institutional accumulation and prices at all-time highs. This is not prophecy, it's measurement. Gold reflects what large institutions believe about the future of the financial system. The pattern is consistent. Multi-year gold rallies precede financial stress. Right now, gold is at all-time highs. The uptrend has been in place for over 5 years. Institutional buying is at record levels. The pattern suggests that financial system stress lies ahead. Gold has predicted U.S. financial stress 3 times in modern history. 3 times it was right. The fourth signal is flashing now.